Hey there, welcome back to our Financial Freedom series. This is episode 4, and it's one I've been really looking forward to sharing with you all. The content in this episode has had a massive impact on my personal financial freedom journey, and I truly believe it will resonate with you too. Over the past episodes, we've covered the foundational steps of the financial freedom path, starting from the basics, moving to the phase where you're just beginning to gain independence, and now we're diving into a critical stage. In this episode, we'll focus on a stage that forms the very backbone of your entire journey. I call it the tracking and action phase. This step is key because it marks a pivotal point in your progression. When we break down the full 12-step journey, this step 4, is one of the most crucial. In fact, I believe if you only focus on this step and skip the rest, you'll still see a major shift in your mindset and actions. And here's the good news: while it's incredibly important, it's not difficult to execute. The only thing you need is patience. Why patience? Because it takes a bit of time, on average about a month. Ideally, you should allow a few months for the best results. So let's jump right in, and I'll show you exactly how to make this step work for you. It's really simple, and here's how you can start. From now on, begin tracking every single expense you make. The way to do this is by using a note-taking app on your phone. Create a specific folder just for your expenses, and from this moment on, every time you make a purchase, immediately log it into your notes. The structure I'm showing on the screen is easy to follow. For those of you who are listening, it's made up of 3 key pieces of information. First, the name of the item you've purchased. Second, the date of the purchase. And third, the total amount spent. Just like that, you'll start documenting everything. Don't skip anything, even the little things. There are some small expenses that might seem too insignificant to bother with, but during this phase, it's not about judging whether they're big or small, it's just about collecting the data. The more thorough you are, the better. As you track your spending, continue to log every expense, no matter how minor. Next up, step 2 is creating a spreadsheet. Whether you use Excel, Google Sheets, or any spreadsheet tool you're comfortable with. Set it up with the structure I'm showing on the screen, and for those listening, let me walk you through the details. In addition to the columns for the name of the item, the date, and the amount spent, you'll also add a few more columns for categorizing your expenses. Personally, I get a bit detailed with my categories, but for now, I'll keep it simple for you. I recommend breaking your expenses into 3 main groups. The first category is must-have. These are essential expenses that you can't avoid, such as rent or mortgage payments, transportation costs like gas or public transit, and grocery bills. These are the non-negotiable, everyday costs. The second category is wants, or things you can easily live without. This category includes expenses like nights out with friends, impulse purchases like video games or a shopping spree, and anything else that's more of a luxury than a necessity. The third category is nice to have. These are the expenses that don't fall into either extreme. They're not necessarily wasteful, but they're also not vital. Examples include paying for a new online course, hitting the gym, or buying that new gadget you don't really need but really want. For now, just keep it simple and sort your expenses into these 3 categories. Once you have your categories set up, the next step is to regularly update your expenses. Ideally, do this at the end of each day. If you let too many days pass, it's easy to forget some purchases. I recommend doing it every day, but even if you don't, just make sure you keep it consistent. You can also enter your expenses directly into the spreadsheet as soon as you make a purchase, so you don't have to do extra work later. The reason I recommend logging each expense in the Notes app first is because it's quick and easy. You don't want to get caught up in figuring out what category an expense belongs to while you're out and about. If you're busy with work or other errands, just spend 10 seconds to jot it down. The important thing is to capture the data, and then you can go back to categorize it later in your spreadsheet. This method has worked for many people, and it's effective because it allows you to collect and categorize your expenses over time. My advice to you is to stick with this for at least a month, but ideally for a few months. Why? Because some expenses won't show up every month. They might only appear every few months. By tracking for a longer period, you'll get a clearer picture of all your expenses without missing anything. After a few months of consistently tracking your spending, you'll have a very clear overview of where your money is going and how much you're spending in each category. That's when you can start making informed decisions and take control of your finances. Let's break this down with an example to make it easier for you to understand. I'll be using this same example throughout all of the upcoming steps, but keep in mind that your numbers may be higher or lower depending on your personal situation. For now, let's assume we're looking at a standard monthly budget. Imagine after tracking your expenses, you've calculated your total mandatory monthly expenses to be $1,000. Now let's say you also spend an additional $250 on other necessary costs like utilities or groceries. So, adding that $250 to your $1,000, you get a total of $1,250. This is what I would call your standard living expenses, what you need to live each month. On top of that, let's say your unnecessary or discretionary spending, like dining out or impulse buys, adds up to $150. This is important because we'll be referring to this number as we discuss budgeting later. So, now we have three important figures: your minimum spending, your standard spending, and your discretionary spending. Now, the next step is creating two more spreadsheets, one called Total Expenses to track all of your expenditures, and another called Total Income, where you'll log all of your after-tax income. Important note, this should be after-tax income, not before tax. For most of you, especially if you're just starting out, your income might mainly come from one source, your salary. But if you have any additional streams of income, maybe a side hustle or freelance work, add those in too. What I've just described to you is what's called in business a cash flow statement, or in simpler terms, a budget balance sheet. This is where we balance our income against our expenses. In an ideal world, your income should match or exceed your expenses. For example, if your total expenses are $1,250 and your salary is $1,500, you've got a surplus of $250. You're in the clear. But here's the thing, in reality, most people with higher income tend to spend more. If your salary goes up to $1,800 or $2,000, you might find that you're still spending that extra money just as quickly. It's common for people to increase their lifestyle spending as their income increases. However, if you find yourself in the unfortunate situation where your income is lower than your expenses, for example, if you're only earning $1,000 a month but your expenses are $1,250, that's a red flag. You could easily slip into debt, and that's something we'll cover more in the upcoming sections. So, review your income and expenses carefully. If you're lucky and don't have any outstanding debts, that's a great start. If you don't know anyone, congratulations, and let's move on to the next steps. But if you're in debt, don't worry. We'll talk about how to tackle that issue soon. If by bad luck you find that some of your monthly expenses are debts you need to pay off, it's time to tackle the next step, debt elimination. To me, this is the second most crucial step in our 12-step financial freedom journey, right after the budgeting process. The consequences of living with debt, which I've discussed in detail in previous episodes, are significant. If you haven't seen those yet, I'll leave a link at the top right corner for you to check out. Now, let's dive into the steps to eliminate your debt. The first question you might have is, where's the money to pay off these debts coming from? Looking at the budget we created earlier, I want you to cut out all the unnecessary expenses from the nice to have category. From now on, you'll live at a minimalist level. This means, in this example, you'll be living on $1,000 per month. This is the hardest phase. It will feel like a serious struggle because you've probably gotten used to spending at a higher level. Now you'll only have just enough to cover your essentials, which will likely go on for a while, possibly 12 months or more. Many people might quit during this phase because it's tough to stick to it for an extended period. Making adjustments for 1 or 2 months is easy, but sticking to this for 1 to 2 years is a different story. Some of you might ask, but earlier, didn't you say I could still have a quality life while pursuing financial freedom? So why does it feel like I'm cutting back so much now? Here's the answer: you're in a negative phase of the journey. The only way to break free from debt is to tighten up and cut back now. It's temporary. Once you get through this phase, your quality of life will improve. Remember, the beginning is always tough, especially if you're dealing with debt, but things will improve as time goes on. Now, to help you pay off debt, the next thing you need to do is open a second bank account. Ideally, this should be with a bank different from the one where you receive your salary. For example, if you're currently using Bank A to receive your paycheck, you can open a new account at Bank B. I'm not endorsing any specific bank here, but you get the idea. Call this new account your emergency fund. The reason for opening a separate account is to keep it as far out of sight as possible. Once you've opened this account, return to your main account, where you receive your salary, and set up an automatic transfer. For example, if you get paid on the 1st of the month, set up a transfer to the emergency fund account the next day. You should transfer, say, $500, or the amount that remains after you've covered your essential expenses. The core idea here is to reverse the usual approach to saving. Most people wait until the end of the month to save what's left. But now, as soon as you receive your paycheck, you should set aside a portion for savings and only spend what's left. This ensures that you're living within your means and that you won't be tempted to overspend. Why is it important to separate your savings like this? Because if the money is easily accessible, you might be tempted to spend it. For those of you with credit cards, it's easy to just swipe and pay the minimum each month, which leads to endless debt. By setting up a separate account, you essentially hide your savings from yourself, making it easier to focus on paying down debt. Once this new account is set up, your cash flow will look like this. Each month, your paycheck goes into your main account, and then an automatic transfer of, say, $500 goes straight into the emergency fund account. From now on, your emergency fund account will only be used for your debt repayment. The next step is to figure out how to tackle the debts. The best strategy is to pay off the highest interest debts first. For example, focus on paying off any payday loans or high-interest credit card debts before moving on to other loans like bank loans or money owed to friends or family. I know this may upset some of your loved ones, but it's important to communicate with them and explain your strategy. You can even share these videos with them to help them understand why you're prioritizing other debts first. Once you've worked through your debts, you'll have a clear roadmap. For instance, if you owe $500 to a payday lender, you can plan to pay it off in a month. Similarly, if you owe $1,000 in credit card debt, you can plan to pay it off over the next 2 months. As you make progress, you can confidently tell your friends and family that you'll have their money back within a few months. By the time you've built this repayment plan, the pressure of debt will start to lift. You'll no longer have the constant stress of owing money. Your life will become less about surviving and more about thriving. Although this minimalist phase might feel tough, living without debt is ultimately far more peaceful. You'll also rebuild your financial credibility. And during this time, all you need to focus on is sticking to your minimalist budget and using your emergency fund account to pay off debt. This process might take 6 months, a year, or even longer, but once you're debt-free, your financial situation will be much lighter and clearer. Here's the good news: once you're done with this phase, life gets much easier. You won't have to deal with debt anymore. Every month, you won't be paying off high-interest loans or credit card bills. You'll be free to focus on building a strong financial foundation for your future. The not-so-good news is that you'll likely need to continue living at a minimalist level for some time. But remember, this is just a phase, and once you've built up a strong financial base, you'll be on your way to a much more comfortable life. Keep pushing through, and things will improve as you continue to follow your financial freedom plan. Specifically, after eliminating your debts, it's time to move on to the next step: building a personal financial model for long-term growth. This is step 6 in our journey: where we begin to create systems that capture cash flow and start accumulating wealth. To set up this model, you'll need 4 accounts. Now, I know some of you might be shocked by the idea of having 4 accounts, but trust me, this is a simplified version of what I use. My personal model actually has 12 accounts, which is more complex, but it allows me to manage different streams of income and optimize some aspects, like tax deductions or building credit, which are crucial in Western societies. While my system works better for me because it allows for more complex management, I understand that many of you are just starting out, and a complex model might be overwhelming. So, I've designed this simplified model, which will help you get off to a smooth start. As you grow in your financial journey, you can always upgrade to a more complex system as needed. Now, let's break it down. Aside from your main income account and your emergency account, which I just explained, you'll need to add 2 more accounts. The first one should be named something like Savings Fund or Grande Fund, and the second one can be called Investment Fund. Let me explain each one in detail. Earlier, I mentioned opening an emergency fund account, but I didn't fully explain its purpose. The idea is that this account is reserved only for true emergencies. This includes situations you couldn't have predicted, such as your company suddenly shutting down, a family member unexpectedly needing medical care, or worse, if you're unable to work due to health issues. These are the circumstances when you would need to dip into your emergency fund. However, it's important to remember that not everything qualifies as an emergency. For example, if your computer breaks and you need to fix it, that's not considered an emergency unless it's essential for your work and you can't generate income without it. The main point is that your emergency fund should only be used when there's truly no other option available. Now, how much should you have in this emergency fund? My advice is to aim for at least 6 months' worth of expenses, or ideally, 12 months. In our example, where the minimum monthly expenses are $1,000, you should aim to have $6,000 for 6 months or $12,000 for 12 months in your emergency fund. So, how do you fund this emergency fund? You'll continue living at your minimal level, just as you've been doing. The good news is that by now, you should be used to living with less, so continuing to do so won't be as hard. Each month, you will contribute a set amount into the emergency fund until it's fully funded. For instance, if you want to save $6,000, which is the target for 6 months, and you can contribute $500 a month, it will take you 12 months to fill this account. While this may sound slow, keep in mind that it's all about being consistent. Over time, you'll have a solid emergency fund to protect you. This is a critical foundation, because once it's full, you'll feel much safer financially. The next account is your savings fund, or Grande Fund. This account is for longer-term planned expenses, not for emergencies. For example, if you plan to buy a new computer, renovate your home, or even start a small side business, these expenses should be saved up in your savings fund. The key difference between the emergency fund and the savings fund is that the emergency fund is for things you couldn't predict, while the savings fund is for things you've planned for. Think of the savings fund as a way to prepare for big purchases or planned investments that aren't part of your everyday spending. The last account is your investment fund. This is where you'll save money that will be used for future investments, things like stocks, real estate, or even starting your own business. This is an ongoing account where the goal is to accumulate as much as possible over time. The idea is that once these accounts are set up, your finances will be streamlined, and you can focus on long-term growth. Every month, as your income comes in, you'll allocate money into these accounts, ensuring that you're building a solid financial base and preparing for both the expected and the unexpected. The key to success here is consistency and discipline. Review your finances regularly, cut back on unnecessary spending, and find ways to increase your income, whether by seeking additional sources of income, like freelance work or investments. Remember, the journey to financial freedom is not about instant gratification, but about making small, consistent improvements over time. Keep focused on your goals, and over time, you'll find yourself in a much stronger financial position. In the coming steps, we'll dive into how to manage and grow your investments effectively, and how to start building additional streams of passive income. This is the phase where you'll start to accelerate towards financial freedom, and with the right strategy, your path to financial independence will become clearer and faster. I hope this session has given you a clearer understanding of how to structure your finances for long-term success. Keep following these steps, and with time and effort, you'll be much closer to achieving financial freedom. Thank you for tuning in to today's podcast. I look forward to seeing you in the next episodes. Wishing you a wonderful day and continued progress on your financial journey.